Hey everyone, welcome back to the Hacker Stacker channel. In this video, I'm going to perform a magic trick right here on the camera. I'll use this dollar bill during this trick. Now I'm not going to use sleight of hand to make it disappear, nor will I burn it to ashes and somehow resurrect it, and you won't see it transformed into a rabbit, a bird, or a bunch of flowers either. However, this trick only works if you, the viewer, has a bank account. Checking your savings, it doesn't matter. It won't work if you don't have one. But here's what I want you to do. Think of a bank account, and it'll have you concentrate on just one if you have more than one. Have you got it? Okay, here's the trick. I'm going to tell each and every one of you who are watching this video exactly how much of your money you have in your account. Every single viewer in every single bank account. I am going to speak aloud how much each one of you has of your money in your bank account. Don't think I can do it? Of course I can. And here's the answer. Everyone watching this video has exactly zero money in their account. That's right, zero. Why don't you have any of your own money in your bank? Well, didn't you deposit it and maybe get a receipt? Sure you did. Don't you have a positive balance? Of course you do. But the truth is, it's not your money. Folks, I appreciate you taking the time to watch my videos. Be sure to like, share, comment, and subscribe, and hit that bell to get notifications on new content. Because it's only with your support this channel can continue to grow. Some of you already figured out how this trick worked. For the rest of you, here's why it did. The simple fact is, the money that you put into your bank account isn't yours anymore. It belongs to the bank. So let me explain how banking works in the United States. When you deposit money into your account, you are making a loan to the bank for the amount you are depositing. Now, many people believe that when they deposit their money at the bank, the teller will take their money and put it in the vault along with all the other money that the other depositors have put in, and that's all belongs to the depositor. But all that money still belongs to the bank, not you. Now, the bank may politely call you a customer or a depositor, but in reality, you are a creditor, and this is very important to understand. After the bank takes your deposit, you have loaned your money to the bank and you become a lien holder. You have a legal claim to the bank's deposits, but still, legally, it's their money. And they're only required to keep a certain portion or percentage of those deposits on hand at the bank. So if 100 people deposit $1,000 each, they don't need to keep $100,000 in the vault. They only need to maintain a certain percentage of that $100,000, a figure called the reserved ratio. This becomes an issue when the economy starts to falter and creditors start making demands on the accounts of their balances. This bank can simply start paying out creditors until they run out of money, and eventually they will not have enough money to pay off the rest of the creditors when they come in. This is what's called a run on the bank. And for those of you who have never heard the term, just Google it. Or watch the 1939 movie, It's a Wonderful Life. George Bailey knows all about it. True, the FDIC will guarantee your deposits up to $250,000 per account, but how long will it take for you to get those funds? And if it's a check, how do you cash it with the banks closed? And if things get really bad, it raises a more serious question. Can the FDIC maintain liquidity? In other words, can they pay off all the claims if things really go downhill? Remember, the FDIC is only set up to deal with the occasional bank that can't pay its creditors. If a large portion of banks fail, the FDIC may not withstand the consequences. True, in recent years, bank failures have become a rarity. But even since 2000, the annual number of bank failures ranged from 0 per year to 157 in 2010. Now here's an interesting tidbit of trivia for you. The vast majority of banks fail on a Friday. This is not by accident. This is because the failure is totally anticipated. This gives the regulators time to settle accounts, make bank management changes, balance the books, and start liquidating the bank's assets. So when the bank opens Monday morning and the anticipated run begins, they're in a better position. That is, if they open at all. Also, it's no coincidence that more failures occur during the start of each quarter, January, April, July, and October. Again, that is planned. This is why it's important to have a stack of gold, silver, and other precious metals, as well as cash. While a major collapse of the economy and the banking industry along with it will likely not be an enjoyable experience, having silver, gold, and other precious metals, along with cold hard cash, can certainly soften the initial blow and hopefully allow you to ride out the worst of the storm until things get, as best as they can, back to normal. Just some food for thought. Keep on stacking, and I'll see you in the next video.